Gold just did something that breaks the brain of every investor watching it. In a world drowning in debt, with inflation refusing to die, with central banks hoarding gold at the fastest pace in half a century, with wars on 2 continents and the dollar losing allies by the month, gold is going down. And if you're sitting there right now thinking, wait, that makes absolutely no sense, you are not alone. And more importantly, you are not wrong. Because here's what most people miss. The moments right before gold's biggest explosions in history, they almost always look exactly like this. Confusing, painful, wrong. Stay with me, because by the end of this video, what looks like a breakdown will start to look like the most dangerous setup in the gold market in a decade. Let's talk about what investors are actually feeling right now. You bought gold, or you've been watching it, because the macro story is overwhelming. The U.S. national debt just crossed $34 trillion. The Federal Reserve has raised rates faster than any cycle in 40 years. Inflation destroyed purchasing power. Bank failures happened. The dollar's global dominance is being openly challenged by BRICS nations. And yet, gold dips. Gold corrects. Gold frustrates. Silver, which has a structural physical deficit, meaning the world is consuming more silver than it mines, is also getting sold off. You're watching safe haven assets get punished in a world that seems to desperately need them. That feels unfair, and it makes serious investors question themselves. But that's only the surface explanation. The real mechanism is something far more interesting and far more temporary. Here's what's actually happening, and I want to walk you through this step by step because each piece matters. Step 1. When the Federal Reserve raises interest rates, it raises what we call the real yield on U.S. Treasury bonds. Real yield simply means the return you get after accounting for inflation. When real yields rise, bonds become more attractive to institutional investors. And gold, which pays no dividend, no coupon, no interest, suddenly looks less competitive by comparison. Money rotates out of gold and into bonds. This is mechanical. This is automatic. This is not about gold's fundamentals. Step 2. When real yields rise, the US dollar typically strengthens. And here's the cruel irony. Gold is priced in dollars. So when the dollar goes up, gold's price in dollars goes down, even if gold's intrinsic value hasn't changed at all. It's a measurement distortion. It's like measuring the same object with a longer ruler and concluding the object got smaller. Step 3. Leveraged traders and speculative funds, the people who trade gold futures on margin, start getting squeezed. When prices fall, they face margin calls. They have to sell, not because they want to, because they have to. This forced selling creates cascades, momentum shifts, technical levels break, and headlines start screaming, "Gold collapse," scaring retail investors out of their positions right at the worst possible moment. That is the machine that is running right now. And here is the critical insight. Not one part of that mechanism touches gold's actual fundamental story. The debt is still there. The inflation is still there. The geopolitical fractures are still there. The central banks buying gold are still buying. The price action and the reality have temporarily disconnected. And this is where everything changes. History shows this pattern again and again. Go back to 2008. Gold sold off hard in the summer and fall, right in the middle of the worst financial crisis since the Great Depression. Investors needed liquidity. They sold whatever they could, including gold. The price dropped nearly 30% in a matter of months. Everyone declared gold dead. Within 18 months, gold had not just recovered, it had launched into one of the most sustained bull markets in its modern history, eventually reaching all-time highs above $1,900 an ounce. Look at 2012 to 2015. After that massive run, gold entered a brutal multi-year correction. It bled slowly. Sentiment collapsed. Retail investors left. Mining stocks were destroyed. And then, quietly, the conditions that would drive the next bull cycle began assembling in the background. By 2020, gold had broken all-time records again. Look at 2021. After hitting record highs, gold spent nearly 2 years correcting, even as inflation surged to 40-year highs. It made no intuitive sense. Inflation is supposed to be gold's best friend, but the Fed's aggressive rate hiking cycle suppressed the gold price through exactly the mechanism I just described. Real yields, dollar strength, forced selling. And then? In late 2023, gold quietly began its move. By early 2024, it shattered its all-time high and kept climbing. The people who sold in the correction, they missed the entire run. The pattern is brutal in its consistency. The corrections feel permanent. the breakouts feel sudden, and the people who understand the mechanism are almost always better positioned than those who only watch the price. But why does this time feel different? Why do so many serious macro analysts believe we are sitting at the edge of something historic? Because the structural setup underneath this correction is unlike anything we've seen in the modern gold market. Start with debt. The United States is now spending more money on interest payments on its national debt than it spends on national defense. Read that again. Interest on debt, more than the military. And this number is only going higher as old, low-rate debt matures and gets refinanced at current rates. There is no mathematical path to solving this without either defaulting, which is politically unthinkable, or inflating the debt away. Inflating the debt away means deliberately allowing higher inflation over time, which is exactly what gold is designed to survive. Then there are the central banks. In 2022 and 2023, global central banks bought more gold than at any point since 1967. Countries like China, India, Poland, Turkey, and Singapore are not accumulating gold because they think it's a shiny rock. They are diversifying away from the US dollar system. They are building reserves that cannot be sanctioned, seized, or frozen. This is a structural, multi-decade shift in how the world stores value. It does not show up in the daily price, but it is real. Then there's the dollar's reserve status. The petrodollar system, the agreement that oil is priced in dollars, which forces every nation on earth to hold dollars, is under direct challenge. Saudi Arabia is openly discussing oil sales in other currencies. China is settling energy trades in yuan. This is slow-moving tectonic pressure, but it is pressure on the dollar's structural bid. And what rises when the dollar's structural bid weakens? Gold. Add geopolitical risk, 2 active wars, growing Taiwan tension, fracturing trade alliances, and you have a world where the demand for non-sovereign, non-counterparty risk assets is rising even as the price temporarily corrects. The surface looks like weakness. The foundation looks like a coiled spring. So what happens next? Let's walk through the likely phases. Phase 1 is where we likely are right now, the final exhaustion of the correction. Speculative longs are being flushed out. Weak hands are selling to strong hands. Technical levels are being tested. Headlines are negative. Sentiment surveys are bearish. This is the uncomfortable, ugly part. Phase 2 begins when the Federal Reserve signals, or is forced by economic reality, to stop tightening or begin cutting rates. When real yields peak and begin to fall, the primary headwind on gold begins to reverse. The dollar softens. The mechanical pressure lifts. This is the ignition moment. Phase 3 is the recognition phase. Institutional money, which has been waiting for confirmation, begins rotating back. Sovereign wealth funds, pension funds, family offices, they don't lead the move, they amplify it. Volume picks up, momentum builds, and the retail investors who sold at the bottom start chasing the price back up. Phase 4, the one that most retail investors never plan for, is when gold is no longer a contrarian position, when it's on magazine covers, when your neighbor is asking about it. That is the time to be cautious. But we are nowhere near that point. We are in the uncomfortable silence before the alarm goes off. So what specifically should you be watching? First, watch real yields. Specifically, the 10-year Treasury inflation-protected securities yield, called TIPS yield. When this number peaks and starts falling consistently, the biggest headwind on gold begins reversing. It is the single most important lever. Second, watch the dollar index, known as the DXY. A sustained break below key support levels signals dollar weakness, which is gold's tailwind. Watch it like a heartbeat monitor. Third, watch central bank gold purchase announcements. When countries like China resume publicly reported buying after quiet periods, it signals the accumulation phase is still intact. These announcements often precede price moves. Fourth, watch the gold to silver ratio. Historically, when silver starts dramatically outperforming gold, closing that ratio, it signals the broader precious metals bull market is entering a more aggressive phase. Silver is the high beta play on gold's macro story, and its physical deficit makes it a structural powder keg. These are not perfect timing signals. Nothing is. But together, they tell you whether the macro engine is warming up or cooling down. Here is the truth that this entire video has been building to. Gold is not falling because the world is becoming safer, more solvent, or more stable. It is falling because of a temporary, mechanical set of pressures that are well understood by history and directly tied to the interest rate cycle. The macro reasons that people own gold: protection from currency debasement, insurance against sovereign debt crises, a store of value outside the banking system, not one of those reasons has weakened. If anything, every single one of them has strengthened in the last 2 years. The smart money does not wait for certainty. It positions during uncertainty, when prices are suppressed and sentiment is weak. Because by the time the breakout is obvious, by the time it's safe, comfortable, and consensus, the majority of the move is already behind you. What we are watching right now may be the last discounted entry point before the next major leg up in gold. Not a guarantee, nothing in markets ever is, but a setup with historical precedent, structural tailwinds, and a clear mechanism that favors the patient investor. The question isn't whether gold's time is coming. The question is whether you'll be positioned before or after the crowd figures it out. If you want more deep market analysis like this, subscribe and stay close to the channel. The next few months are going to matter.